Good morning, everybody. It is Friday, July 8th, 2022, and you are tuned in to Real Estate Talk TGIF, episode 213. That's 210 weeks in a row, more than 4 years. We have not missed a week in that time, and we don't think we're ever going to miss a week. You never know. Knock on wood. But anyway, today I have a really great guest, great information guy, great mortgage guy, great financial guy. Ralph DiBugnara, several ways to say it. Anyway, here we are.
Right. Yeah.
Yeah. So it's like everybody's saying, okay. So, and the great part about Ralph, hey, the great part about it is you make it easy for everybody when you have your Instagram that looks like that. So it makes it really, really easy, and you can see that on the site as well. Anyway, Ralph, you are the president of, okay, so it's right. You're the President of Cardinal Financial,
yep.
And you are the president of Home Qualified. Hey,
Correct.
Ralph, we're going to be right back. Thanks so much for coming on today. We're going to be right back and talk more about everything you got going, man. Everything you got going. And here we go.
Real estate agent, are you looking to acquire clients consistently so you can grow your business and your income to live a great lifestyle? This is Dave Finale and the RE Skill Builder podcast.
Okay, so one of the things I do really well, as you just noticed, is I fumble on introductions and all that other stuff. So anyway, here we are, Ralph DiBugnara of Home Qualified, Cardinal Financial. Ralph, tell us how you got into doing the things that you're doing. You've got so many significant things, and you help an awful lot of people.
Thank you.
Which is my main goal in life, and you know, you help me to aspire to get to where you are. Talk about what you do and how you do it and how you got there. What's your journey like?
So I'm in the business 21 years now. I kind of fell into it by accident. I graduated college during the .com bust, and it's a little bit similar to kind of what's going on today, to be honest with you, as far as what's going on with internet stocks and overvalued stocks. So I got in then. A friend was in the mortgage business. He got me a job. I didn't really have a lot of options at the point. I wasn't really that good at school. And I kind of got in and rode that wave till 2008. I bought my first property in 2003 when I was about 23 years old. And I was in the market doing very, very well at a company that was owned by Deutsche Bank. So I was a vice president at Deutsche Bank, which is a publicly traded investment bank, till about 2008 when they shuttered their mortgage division. And then I went on a roller coaster for about 3 or 4 years, lost everything, went from living in a penthouse on Wall Street to a 600 square foot studio in Staten Island, and started over, dug out of debt, got my properties back healthy, went back to being a loan officer. At the time of the crash, I was doing probably somewhere about $500 million worth of business with my group in 2006, 2007. That went to zero. It didn't go to like 100 million. It went to zero. And I had to literally go back on the street and go back to being a loan officer and a salesperson. And what's great about that, I think, is that I always know that I have that skill to go back to. And no matter what happens, I'll be able to do it again. So, and then I started to rebuild. And around 2012, 2013, I started a new group that's probably a lot of the people that are still in my group today were part of that group in 2012 and 2013. I started my own group again. I grew from zero till about 2018, where it was about $300 to $400 million a month. Currently, between me and my partners, we're doing almost $2 billion a year. We did 1.92 billion last year, and this year the market will be down a little bit, but we'll do a little bit less than that. But we're close to $2 billion a year in residential business. So that's the mortgage part of my life. And real estate wise, I have a portfolio somewhere between 23 and 25 homes. I'm selling a couple of houses right now, but that's somewhere in the range of between 20 and 22 million. My real estate portfolio.
So you mentioned that your business is going to go down a little bit this year, and that's probably the biggest topic that everybody wants to hear, wants to talk about in this July of 2022. Talk to me about what your vision is on that, and as far as what the market looks like today. Now, we've had rates go down a little bit, right, over the past few weeks.
Sure.
How significant is that, and what do you see moving forward? Because rather than wait and get to that later, let's just hit it head on.
Yeah, no, I mean, I'm someone who feels in the mortgage business, we've been feeling it for about 4 months now already because refis disappeared completely, and that was a big part of the business last year. I think that the realtors and the real estate market is starting to catch up to it because what we were experiencing a few months ago, now everybody's experiencing. I personally feel that we're in the middle of it right now. We're in the middle of the worst part of it right now. I think that it may get a little bit worse, but it's not going to get a lot worse. And I think that you're going to see by fourth quarter of this year us come out of it and be back into what's mostly a stable market that we were experiencing in 2018 and 2019, a healthy, stable real estate market. There's no market crash coming. Not in my opinion, and I have a lot of reasons for that. But I think that we're in the worst of what it's going to be right now, and what it is right now is rates are higher. People are tentative to buy and or sell because they don't know where the market is going, and everybody's just kind of standing still. The good news is they're not panic selling, they're not foreclosing, they're just standing still. So I think that this is part of what the worst of what we're going to see, and I think by late fall, early winter, you're going to see us back to a more stable market.
When you say stable market, now I am one that has said forever that we haven't seen a real normal market since September 10th, 2001. I mean, I've been in the business over 40 years, own my brokerage, right? That's when the last normal market, we're really getting there at that point. And now today, I agree with a lot of what you say, because I believe that over the next 6 to 18 months, we're going to see that normal. And it's going to it's already freaking people out.
Yeah.
Because we've started normalizing, and there's like panic in the streets, when it comes to realtors and some mortgage people. Do you think there's going to be a depreciation of homes in the near future?
I think that my personal opinion and what I'm seeing from what I'm buying and selling in the market is that the homes that are overpriced are going to sit on the market like they did before, or going to have price drops. The homes that are priced correctly will sell and in normal time frames still. Maybe there'll be a little bit of a delay over the summer just because people are a little bit tentative right now. But the homes that are priced correctly or underpriced will sell fast. The homes that are overpriced will have price reductions and or they'll sit on the market like they did before. And I think that's more of my definition of a normal market. The bidding wars, the crazy bidding wars are going to come to an end.
Right.
The highest and best on day one or day two is going to come to an end. You're going to get back to a competitive market where qualified buyers will buy, sellers will have to sell for a reasonable price. It won't be waive inspection, waive appraisal, waive all this stuff. It'll just get back to the normalcy of what we were seeing between 2010 and 2018. And I agree with you that wasn't completely normal, but but it'll be more like that than it is like 2020 and 2021. So
what I've seen is it actually goes back to this word panic I used, and I think it's more of the agents not being skilled enough. Where in 2004, 5, 6, whatever, I believe that this industry, this real estate sales industry, turned into more of order takers and everything else, and it took really people in 2008, 9, 10. The ones you didn't know about to excel and to learn the business, struggle a lot, and today they are the leaders of this of this industry, and we're lucky to be involved with a lot of them, like Brett Sikora, Dan Beer, all these people, right? But we had these order takers come along that happen to be in the right time, the right place for listing. Today, what we've got is, okay, so what do I say to a seller? What do I say to a buyer? Now, plain and simple, if you get 10 showings in a week, you should get an offer. If you don't get an offer, we need to relook at this number, at this price.
Correct. Yeah, you're right.
We need to look at that price. But the difficulty here, Ralph, and why I go through this diatribe on this is that agents don't know what to say. So the last people in the world to understand the market and to get it in their heads are our consumers, the buyers and the sellers. So what do you say to that seller? What do you say to that buyer to kind of convince them, sell them on yourself and what to do and how the strategy should go forth?
Yeah, I mean, so the most important thing for buyers and sellers is, and I've always said this, and I'll stand by this forever, is that what is your budget and what are you willing to sacrifice to buy a home, right? So if my budget is $5,000 a month to spend, then I have to fit that home within that $5,000 budget, along with all my other expenses, and that's my health insurance, my car insurance, my cell phone bill, all that stuff, right? If you can find a home that fits your budget, it doesn't matter necessarily what the interest rate is on that home.
Exactly.
So it's payment. You make that payment every single month. And, to further go along that, say investment properties or even your own property, rent has been up at least 8.8% every year since 1980, right? So telling you that even in down markets, Dave, even in 2007, 2008 in crashes, rent was still up. Rent was up 25% last year. It won't be up 25%, but inevitably, no matter what happens to the market, your home is going to appreciate something, and the value of what it's worth monthly to somebody is going to go up. So no matter, even if you're paying 6%, 3%, or 10%, as long as that payment is something you can afford, everything else around you is going to appreciate, and it's still a good investment.
100%. And what you've done is you just define the word cost, because there's a price and there's a cost, right? What you're paying for the house and what it's going to cost you. Two completely different things, two completely different things to look at, right? And I want people to understand too that cost is not only, the mortgage payment, the property taxes, the insurance. It's also, is there a school thing involved where you don't like the school system, so you go to private schools, for your kids. That's a cost as well. And you have to think about all this stuff coming together where it's just more than the principal, interest, taxes, and insurance, right? Would you agree with that?
100%. Yeah. And, and I think that everybody knows who Warren Buffett is. Whether you're young or old, you know who Warren Buffett is. And Warren Buffett is what's considered a value investor, which means he buys companies based off of their value. And when he says value, he means long-term value. So so if he's looking at companies and assets like that, real estate really is the same thing. I'm buying it for this thing, but what's my long-term value with this? Whether it's a monthly income for investment or it's appreciation. You can't look at a property and say, oh, well, it's worth $500,000 today. I hope it's worth $600,000 next year. No, if it's worth $550,000 in 3 to 4 years, then my investment appreciated and it was a good investment. So I think that, we're just got so caught up in these huge gains that that's not the real market. It never has been, but it doesn't mean it's not a good investment.
So what do you think? So when we talk about these huge gains, we're talking about equity, and people have lots of equity in homes. And I think that's one of the things that's going to help us. But, I asked a question before that you answered. I'm going to ask it again a different way. Is there going to be a reduction in price where there's going to be issues with foreclosures or short sales, et cetera? Is that what we're going to see like we saw 15 years ago?
No. So I think that I think that you'll see a 10 to 15% possible reduction in some areas, not all areas, in prices.
Right.
You can't have a market crash. And this is that, like we saw 15 years ago. And this is why. In 2008, you had an oversupply of homes and not enough even market demand to meet it at the time. The reason why the mortgage business had such a problem at that point is because Wall Street was saying, hey, these mortgage bonds are paying so much money. We need more. How do we get more? Okay, drop your credit scores your credit score requirements to 500 and raise the LTVs, right? So all they were trying to do at that point was to try to create demand so they could create more mortgages. There wasn't enough demand to fill the houses we were building at that time. Now we have an undersupply of homes. We still have a shortage, and we're going to have a shortage for 2 to 3 years. We have an adequate amount of demand for those properties and almost a shortage of demand for those properties. And you have stricter underwriting guidelines where you can't get financing as easy as you could during that time period. So just those 3 factors alone shows you that there can't be any kind of significant crash. The other thing is that Americans have about $1 trillion of equity in their homes right now. If you look at that compared to 2006, 2007, it's almost triple the amount of equity people had then to now. So people's houses aren't underwater. They're not in danger of being underwater. So you're not going to have foreclosures as much. So just a bunch of things like that tell you that it's not the same.
No, it's not. It's not the same. And the equity is there. And one of the things that happened from 2008 to, over the past 10 years has been that not only equity has increased, but also savings accounts has increased. And I'll put that in quotes, right? Because that's really important to know. Back then, quick story, when I had my brokerage, I had an agent that came in, he did 8 deals in 1 week, and the total down payment was $3,000 and all those 8 deals put together. That you will never see. I don't think you'll ever see that again. But
right.
The point I'm making is that nobody had money. I mean, and they were able to get homes. Now what we're seeing is that we're seeing cash, we're seeing savings, we're seeing all that increase, which is probably going to save us from a terrible, terrible recession.
I agree.
We're going to see it. Inflation is it. There's nothing you can do about it. We're at this point now. So let's take a little shift in this conversation. Let's go to Home Qualified. Talk to me about Home Qualified, because it's very intriguing to me, having looked it up and done a little research on it. Tell me all about it. Tell me why you started it, what it's all about.
Yeah, so homequalified.com is really a real estate news and education website. I started it because it was my way to get into social media. It was the way to kind of get my voice out there to make people familiar with it. So I started doing educational tip videos. It's really how I grew my Instagram from 0 to 114,000 followers, was through that platform. Started about 2015, 2016. And it's meant really for either first-time home buyers or first-time investors or people who are looking to scale their portfolios. But we put articles up there weekly that really address that. Real estate invested, real estate buying, first-time home buyers. I have courses that I'm starting to release through there. So right now I've bought about 15 Airbnb or short-term rental properties over the last 2 years. So the course we have up currently is called The Next Real Estate Gold Rush. Right. And that's educating people on how to buy short-term rental properties and scale it. And Home Qualified was initially a way to get people familiar with my voice as a real estate expert in the business. And now it's become really more educational than anything else. It's a free website. There's no joining. I'm just trying to educate people on what the value of investing in real estate.
So one of the things that Home Qualified talks about is being a millennial advocate, educating the home buyers in the market and home buyers of the future. I know millennials is the majority of our market today, but there's also the other generations coming up. Tell me about how you do that and how that works. Yeah,
so I think that the millennials are the largest buying group currently, right? But I think that what you have after that is now you have Gen Z coming. And I think that what we're seeing about generations as they progress is that they're more educated. There's more information out there for it. But at the same time, they've never been through certain things. Like the generations after millennials, and even some of the younger millennials, have never been through a recession before, right? They've never been through a shortage of supply of homes or goods or anything like that. So now it's like, hey, you're going to invest, but you can't just look at historical factors on investing. You have to look at what's currently going on in the market and how the market has shifted. So we're trying to educate that demographic on this is what history looks like. This is what's going on today, and this is what we think the future looks like. Those three factors on how to how to buy your first home or how to invest in real estate.
So is there a difference between, or what is the difference between baby boomers and millennials and what they're looking for in buying a home?
Yeah, so it's a great point. I think that is even changed in the last 3 years, right? Because now it's a virtual world, right? Like most people are working from home. A lot of people are schooling from home. So what they wanted 5 years ago, was a better commute, a good education system for their kids, more access to activity or social life. Some of that stuff is still present, but some of that has changed. I want space. I want a bigger house. I want something that's functional so I can work from home every single day. I don't need to have a good commute because I don't have a commute anymore. So I want a state or a county or a city with good with low property taxes or low income taxes. So I think that those things were, whereas baby boomers were, I got to get on the bus every single day. I got to go to work, or I got to travel to work. It was just a completely different. Baby boomers were great on believing on the fact that they had to real estate was the best investment vehicle for them, and they wholeheartedly the American dream. They believed in that. I think people still believe in that, but their needs are different,
or their wants and desires are different. They were brought up differently than I was, than you were, and moving forward. So when we talk about demand, right? Demand is still there. It's just like there's like people that have, that have gotten out, and there's people that have freaked out, right? And but there's demand for housing, and we talk about housing units being built, and that's been lagging behind probably anywhere from between 1 to 2 million units over the past 10 years of new construction. So one of the things that has always been a question on my mind, I'm going to ask you your opinion, is in northern New Jersey, where I am, and all over the East Coast. And I thought it was just the East Coast. I thought it was just my area, but I've been to Dallas, I've been to Florida, over the past several months. And what I've seen is these large apartment buildings being built all over the place, all over the country. How is that going to impact the housing market, in your opinion?
Yeah, so it's a really, really interesting point. So as you noticed, when we went into COVID and the pandemic, that stuff was the stuff that went first, right? Like that was the stuff that was suffering the most. People were moving out of the most because they wanted space. Now, when things have gotten a little bit more back to normalcy, it's funny because you would think people would be moving away from cities and places that are like metropolitan areas. It's actually the opposite. Now there's been a flood back in. And I think the reason for that is that people took the opportunity to get a cheaper price on those types of places and they moved closer. Now everybody else is coming back, but you have a growing population. You're still going to have a need for housing that's not huge. And like you said, like we're in New Jersey, right? Or New York. They're not making land you can build on anymore. If you go down to the Carolinas, if you go to Texas, if you go to the West Coast, Arizona, Las Vegas, those areas, there's still a lot of building going on because there's space for it. We don't have the space for it. So then you build up. So I think there's still going to always be a need for that stuff. Wherever people are working from, whatever they need, I think there's still going to be a need for that stuff. I don't see that stuff going anywhere. But I will say this. During recessions and high inflationary periods, right, the stuff that does the best is resold or refurbished homes, not new builds, because materials get scarce and expensive, which is what we're seeing right now. So I think the ramifications of that over the next few years, you'll see that building slowed down a little bit because of what's going on right now.
Right, exactly. It's just, I mean, the material stuff has gone crazy. Just a quick fact. I mean, you talked about people wanting different things as COVID hit, and as COVID coming out of COVID, different things happened. I saw a statistic, and this is one of the things that most impressed me with housing numbers. The area in the country that had the most amount of people leave per unit was in New York City, Chelsea.
Yep.
The area of the country that had the most amount of people move into, guess what? Chelsea.
Yeah.
Amazing, right?
Yeah,
because what happened was the prices went way down to get people in, and now guess what they're doing? Their prices are above pre-COVID numbers. And that, are we going to see a boomerang like that? Are those prices ever going to come down, say in Manhattan or everywhere else?
So historically, the major cities, everything happens first. New York City, San Francisco, Chicago. So people left first, people went back first. Prices went down first, prices will go up first. Now what you saw in Manhattan last month, I saw it yesterday, that there was 30% less new listings on the market last month in New York City first. So you're going to see that now that'll trickle down. There'll be every other state will completely follow. New York and San Francisco specifically are usually leaders in this because they're the two most expensive real estate markets historically. So I think that you're going to see the rest of the country see the same thing that happened in Manhattan happen now. People will then that'll be the first place that people use as an opportunity. Oh, home prices are coming down. Let me go back and buy. So I think that it's a great gauge to look at areas like that to what's going to happen next everywhere else.
It's a really great point. It's a really great point. So do you think that we will see more and more homes being built, single family homes being built all over the place? Or is that going to be relegated to what the price of the materials are?
If you look at the Builders Confidence Index, which I think came out last month, it usually talks about the next 2 quarters of building. Their confidence was the lowest that it had been in like 5 years. Last time they put it out, and that was based around interest rates, material supplies, and demand. So I think that you will see a slowdown of new home builds over the next year, until stuff kind of gets a little bit more stable. Prices get more stable. Gas costs come down. Material costs come down. The supply chains get back to normal. So that index is telling us that for the next like 2 or 3 quarters, you're definitely going to see a slowdown in building.
So let's talk about, we've gone from millennials and baby boomers and all that stuff. Talk to me about investors, flippers, like the one-offs, the people that do it for a complete living. We had Charles Weinrob on last week,
he's great at that.
Handsome home buyer who's fantastic. And he was on last week, and he had his own opinion about what's going to go on with that and who's going to be in, who's going to be out. Talk to me a little bit about that.
Yeah, so I think that so like I haven't flipped properties recently. I'm selling a couple of things now that I bought recently just because they appreciated so much. I didn't flip them on purpose. I haven't been flipping property because I don't feel like the margins were there for people who really wanted to do it. I think that they don't want to take that much risk to make $20,000-$30,000. There wasn't enough margin in these deals to make them work. I think as you see that the market come down a little bit, you'll see more people get back into that.
Sorry about that. Go ahead.
That's okay. They'll be able to buy properties off market again. You'll be able to buy properties that at a reduced price. You'll be able to do that kind of stuff. So I think that that's what you're going to see now. I think that property flipping will come back, but it probably won't be till next year.
All right, great. So who's going to be doing the investing now? Is it the unknown? Is it the people that are just going to do one at a time and just get them done in a couple of months and go back and flip it? Or is it going to be the heavy duty investors? Because what I understand is the heavy duty investors are just going to get rid of what they got and hold off and wait. So there's going to be investing. Who's going to do it?
I think that first you're going to see the experienced people do it again. The experienced people who will see the opportunity in the market, they'll see it first. And that's what will happen first. I think a lot of the things that the newer investors were investing in, like cryptocurrencies, like NFTs, like other things that were distracting people away from real estate, are now going to become less desirable for at least a short period of time because they're very volatile and people don't know what's going on with their money. So I think you'll see those people come back to real estate as well. So I think it'll be the experienced people that recognize the opportunity first, but then you'll see the investors who had all their money other places come more and more into real estate because real estate is going to be the new gold. Real estate is going to be the new treasury notes and the bonds. It's going to be the most stable, secure investment in the market is going to be real estate, I believe, for the next 5 to 10 years.
Okay, so I got two questions to follow up on that. One is, what about the money? Is the money available for these investors, whether it's from conventional means or hard money? Is it available?
You're asking that question at a good time, an interesting time. So we've seen over the last 2 weeks a lot of these non-QM lenders, which were the more aggressive lenders lending to investors, go out of business this week. I think you're going to see some more attrition in that over the next few months because those companies that were offering more aggressive loans to investors were securitizing it to Wall Street. If just like 2008, if Wall Street doesn't have an appetite, they have nowhere to put the loan and they don't have enough funds to keep it going. So I think over the next 60 to 90 days, you're going to see some more people go out of business. I think if interest rates come down, which they seem to be teetering on right now, it seems like up until today, when the unemployment number came out, people started to be more scared of recession than they were of inflation. And rates came down over the last 10 days. If they continue to stabilize, if the number comes out next week and inflation is down and consumer spending is down, you'll see rates trend down again. I think it'll save a lot of people's lives, and a lot of these companies that were lending money to investors will be able to stay in business, and you'll see the lending continue. If that number is up again and they have to continue to raise interest rates for the rest of the year, you're going to see some people go out of business.
Yeah, I agree with that. I agree with that wholeheartedly. I think but just to follow up on that question are the people, you said it too, I think, but in a different way. Are the people with cash going to be king and when it comes to investing?
Yeah, correct. Yeah. So that was the thing, right? As real estate investors, you used to be able to go to a property and say, hey, I'll pay cash, and you would be able to get a better deal and a faster close. Now everybody had cash. Everybody had cash over the last 2 years. That's going to go back to normal. And the people who cash is going, I believe I want to be in more cash now than I have been in the last couple of years. I want to wait. There's opportunities coming to buy, and I want to be there for those opportunities.
Great. So one of the things that I noticed over the past 20 years in this business is that the government, you said something to this effect a minute ago, which made me think of this. Government did not understand. The politicians did not understand that real estate makes the world go round. Right. It absolutely does. Right.
1,000%. Yes.
Right. It's been that forever. In 08, 09, our complete government didn't understand it, and they didn't do shit to help. Right. They just let it happen. As far as this is concerned, and you said that real estate is going to be the new gold. Is that what you're meaning, that the entities that can help us politics wise, government wise, are actually going to be supporting the real estate industry, real estate worldwide? What do you think?
No, so I think that I think that they're showing us again that real estate is what moves this country.
Right.
The only reason they keep raising the interest rates is because they're trying to slow down the economy. Like, so they're trying to slow down spending. So that hey, if we slow down real estate, we can slow down spending on everything, because people just don't buy homes. They have to buy goods for their homes. They have to buy supplies for their homes.
Right.
Real estate is what really runs this country and has forever. So I think that real estate is and will continue to be, even more than ever, the most important factor and investment tool. And I think that because everything else is so volatile at this point, cryptocurrencies, NFTs, even the stock market is because of technology stocks is ridiculously volatile at this point. Real estate can't swing like those things swing. So I think more than ever, the safe money is going to be invested in real estate, and that's going to just grow and grow and grow. Now, that maybe becomes some virtual real estate stuff over time, but I think the safe real estate is going to be the safe investment for the near future.
I think it's been the safe investment forever. I mean,
Me too. I agree with you, but I think people who went through 07, 08, and I did too, and I had problems, may disagree. And I think that you had a lot of millennials and people grow up in that market, and they think that real estate is a dangerous thing. But realistically, if you look over history, it's always been the safest investment.
Yeah, exactly. And one of the things that I always go back to what my dad taught me. My dad was a dentist, but it was really heavy duty in real estate. It was more of a hobby for him, but he had a lot of it, and where I learned everything. He was a great mentor to me. And one of the things I asked him once was, Dad, why do you buy real estate? I mean, why do you buy it? I mean, because he wasn't a big developer. I mean, we did a lot of developing, we did a lot of building. But there were things that he didn't do. And I said, why do you have this if you're not going to do anything with it? He says, because it's something I can hold. It's something I have. It's something I can see. I can stand on it. Stocks, I know nothing about, he goes, right? I can't hold them. I mean, they're paper I can hold, but I don't know what it is. I can't see it, right? So, and then the famous line, which I don't know who said it first, he would say, land, they ain't making any more of it.
True.
Yeah,
it's true. And you're always, and you hit on two good points. I mean, to this day, crypto, NFT, I've dabbled in investing in that, but there's no historical trends to tell us what's next.
Right.
There's nobody to tell us, hey, this is what's going to really happen now, because there is no reporting on it like that. We're just following waves.
Right.
Whereas you have 100 years in history in real estate and stocks. So, and real estate, more than anything, like you said, is something you can hold, something you can physically see appreciating. I just think that that's where the smart money is going at this point.
Oh, without question. I agree with that too. So then we've got this thing. We've talked about that rates have come down a little bit recently, and we've seen the fluctuation a little bit in the market. The market's going down. Last month was the first month there was actually an increase in home sales, or maybe it was May. I'm not sure which. But talk to me about financing in and of itself. I mean, there are people that have been knocked out of the market because of the cost and the rates going up from 3 to 5, 3.5 to 6, right? There has to be, there was, and like you said before, what happened in the first decade of this millennial is people got actually, they cut down, the scores you could get and the money you had to have, et cetera, LTV, et cetera. What kind of creative financing could we get? Because years ago, we came up with so many different things in the 80s, and we're able to get things done because interest rates, if you might not remember, but I do, we're like at 18%.
This is when the agencies, Fannie Mae and Freddie Mac specifically, are going to get creative to make home, because those are government agencies, right? So they're going to get creative to make home financing more accessible and affordable, but not risky. So what you're going to see is they're going to figure out ways to get people to qualify for the market prices today with mortgage products the way they would have when interest rates were lower. So I believe you're going to see a 40-year term mortgage in the very, very near future. That's going to be first, maybe even a 50-year. which sounds crazy, but people are living longer, so I guess it's not so crazy anymore. And by extending the term from 30 years to 40 years, it'll make the payment a lot lower, and you won't need to have a 3% interest rate to qualify for that house that you wanted that you can't qualify anymore because the rate's 6%. So I think that's the first thing you will see as far as creative financing. I don't believe you will see creative financing in the manner that we saw in 2003, 2004, 2005, 2006, where it was just too aggressive. It was 100% financing. People had no skin in the game. They didn't have credit score that viewed them as financially responsible. I think that for people who are financially responsible, who keep a good credit, who handle their finances better, there'll be more creative options where you can get your payments down and you can afford the house that you really want to buy.
Yeah. So in other words, what you're saying is we're not going to see these interest-only loans. We're not going to see these crazy ARMs. I mean, there are ARMs out there now, adjustable rate mortgages, but they're really nothing. I mean, you're basically paying down a rate for a temporary fix, right?
Yeah. I mean, they're not like, so adjustable rate mortgages are a hot button topic again. So like, oh, adjustable rate mortgages to get your payment down. Yes. But the terms on adjustable rate mortgages for the most part at this point are either 5 years, 7 years, or 10 years. So meaning they're fixed for the first 5, 7, or 10 years. Where we got in trouble in the early 2000s is that the adjustable rate mortgages were 2-year terms and 3-year terms. And furthermore, in New Jersey, which is, and in probably 40 states, not only was only a 2-year term, but it came with a 2-year prepayment penalty. So you couldn't even get out of that loan before 2 years without paying a penalty. So you were stuck until the rate adjusted.
Right.
And on top of that, you were at 100% finance because you had no equity in your homes. So those are the ways that people got in trouble. The terms are longer. They're meant really for more sophisticated people who want or taking it for a reason. And I just don't think you'll see the same, attrition you see before with that.
So in other words, there's a phrase we talked about the other day, and we've heard it a lot, and at least in my circles, marry the house, date the rate. So in other words, buy the house, and you can always refinance depending on what you're going to do, and it's still a great investment. What do you think about that?
Yeah, I mean, I think this goes back to payment, right? Like marry the house. Your house is a long-term investment. It should be viewed as a long-term investment. It should be viewed as it's going to appreciate over time. I can pay this payment every single month. That mortgage payment of $2,000 or $3,000 or whatever it is this year, if you rent, would go up next year. If you own, that payment you have now of in 2022, 2023, 2024 of $2,000, that payment for that house would be $5,000 7 years from now. So you have to look at it that way, that your payment's not going to appreciate. It's going to stay fixed. And that fixed payment, as long as you can afford it, is the best thing for you.
Yeah, and a way to look at the alternative, which is renting, understand that with your mortgage payment, it's going to remain the same. It's going to be flatline, and your equity is always going to increase. When it comes to rent, your rent is always going to increase, and your equity is always going to be zero. So that's one way to look at it. All right, so I got one other thing that's really interesting, and I've been thinking about a lot, and I've been doing a lot of research on it.
Okay.
Is it possible, and are there a lot of these loans that have gone out over the past few years that are assumable?
So there isn't a lot of that stuff right now. I think that you will see that stuff come up in the future again. There just hasn't been for the last 2 years because there was really no appetite for it, because banks, weren't looking to be in that business, especially when they had very, very little ability to foreclose.
Right.
So there's not a lot of stuff right now. I think that in a normal market, that is a normal product and a normal process. I think you see it again in 2023 and 2024 and 2025, but It's not, probably in the next 6 to 12 months, it's not going to be something that's very popular.
Okay, great. So we've gone through a lot of different things in a very short amount of time. So I've got to ask you about the sign that's behind you, Disruptors Network.
Yes.
This is where one of the ways I first got involved with you, or saw you speak and saw you do a great job at an event a number of months ago. Talk to me about the Disruptors Network, what it's all about.
So Disruptors Network was something I created originally to as an education or an educational seminar. It was originally called Real Estate Disruptor. And the first couple of conferences I had, I used to bring in speakers to educate people on how to brand themselves better within this business. Disruptors Network is something that I changed over to during COVID. I was sitting in my office by myself every single day. I started to do something similar to this. So let me have something once a week that educates people on what's going on in the market today, what happened historically, and what we can expect to happen over COVID, future, what's going to happen. with that, I started to bring people on. When I started to bring people on, I was like, there's some power in this. I turned it into a television show called The Disruptors Network that was on YouTube, Amazon Prime, Roku. So if you go to any of those platforms, you look up Disruptors Network, you can watch the show. And I had 8 episodes, and they were based around people who are successful entrepreneurs who had built businesses on their own and was showing other people how to do it, which is what I was trying to do. That turned into more seminars, more educational seminars. It's a podcast called The Disruptors Network. And season 2 of the television show is coming out in fall of this year, and it's going to be on DirecTV.
Awesome. That's great. Man.
Yeah. So, and the conference that you came to see me at, which was Decoding the Disruptors, that's the last episode of the television show, actually.
Oh, that's great. And that was a great conference. You had great speakers there, along with the Brad Lee, which was amazing. Yeah. Right. He was there. You were there, obviously. Brett Sikora, our friend. So I also heard something recently that you also have a book coming out. Is that right?
So I have a book. It's called The Growth Trap. The Growth Trap is something that I've kind of gone through my whole entire life. And the definition of it to me is, when you're born to the ages of like 17 or 18, we kind of grow naturally, right? We get bigger, we get stronger, we get smarter, we get more adapted to, but without doing anything, it kind of naturally happens, right? We're a sponge, and it naturally happens. You get to a point in life where growth doesn't happen automatically anymore, and we have to force it. And that's a growth trap. And I've been through a million growth traps in my life where I got stalled because I didn't recognize that I was in this stagnant state. So the book is essentially about my story and a lot of other people's stories of people who were trapped in growth, and the techniques they used to get out of it to grow their businesses, their lives, their families, and all the things that we've done to do that. So that's the Growth Trap. It'll be available. It's available now for pre-order on Target.com, and it'll be available on my website, DiBugnara.com, on July 31st.
That's fantastic, man. I appreciate that. For my personal story of having come through working with family, et cetera, and going through different hurdles and detours and roadblocks that I've built myself, right? Not things that was put upon me. I put them upon me myself. And I think the biggest thing for people to understand is a couple of things. One of the things is I really believe, and people can disagree with me or not, you really need to own your shit, right? You need to take responsibility for everything. It's just like people say, well, how can I take responsibility for everything? If I'm at a traffic light and the person hits me from behind, how is that my fault? And say it was your fault, you have responsibility for it. Because what if you took another way? What if you weren't late? What if you weren't 5 minutes late going to where you're going? Right? Yeah. That never would have happened. I had a car accident. I didn't have somebody hit me, and I took full responsibility for it. Not to pay for it, obviously, because I didn't hit me.
Yeah.
But I took responsibility for it because I knew that when I went somewhere and I was coming back from, I specifically waited an extra 5 minutes before I left, and I delayed, and that was my fault. That's why I took responsibility. So I believe anybody who's got detours or got roadblocks, got all this stuff coming on, they really need to own their shit. And as you get deeper into that, I'm sure you can agree, it gets more enlightening, and you see more of it and say, oh my gosh. And, so that's my little, my little thing for today.
I love that. It's amazing. You're right. If we took responsibility for our good, bad, and ugly, we would be a lot better off every single day. So you hit it right on the head, Dave. That's great.
Right. So man, this has been one of the really key days of this broadcast, Real Estate Talk TGIF, and I've really enjoyed it. And what have I missed, Ralph? What have I missed about Ralph DiBugnara? What have I missed?
Yeah, I think that a lot like you and this podcast, my real goal with all this stuff is I really enjoy helping other people. My father was an educator. I grew up with an educator. I really enjoy educating other people. He really seeped that into my brain. So that's if I feel best when I'm helping others, and selfishly, right? Like selfishly, I feel best when I'm helping others.
Right.
So I think that my platforms, whether it's Home Qualified or Disrupt This Network or Cardinal Financial or the Growth Trap, my goal is to really help those around me be better leaders. And then as leaders, we can stand next to each other and grow our businesses and our lives and everything else. So I think that's really what my goal is in life.
So the one question I ask at the end of every broadcast, and we're nearing the end, a couple of more things, and how First of all, how do people get in touch with you? We have your information on. I just want to have you put it out there, how people can get in touch with you. They're looking to work with you or help you.
On social media, my Instagram handle is Debug. It's on the screen, DIBUG. I answer all my messages there. If you need anything, if you want anything, go there. RalphDiBugnara.com is the website. You can get me there. Ralph@homequalified.com is my email, and my cell phone number is below as well. So any of those places, you will get me.
Awesome. So here, my last question, aside from one other point, is this. How can I, Dave Finale, help you grow your business?
I think this is awesome. I think by continuing to do this on your platform, Dave, makes my episode with you more relevant. And I think that the fact that you're putting information like that, now I'm associated with you, helps me every single day. So I really appreciate what you're doing. And I think if you just continue to grow what you're doing, it'll help me.
Well, that's fantastic. So last but not least, as you know, everybody that comes on a broadcast gets a hat. And you know what? That's why you said, Dave, do I get a hat if I come on? I said, absolutely. So I want you to know that you'll be getting your hat.
That's awesome. Thank you.
I want to thank everybody for watching this live and or watching it in the future on a rebroadcast. Next week, we've got a great broadcast coming up. We've got Jeff Chiani of Branded Age University, NAEA, National Association of Educated Advisors, coming on next week. Somebody I actually work with now. So that'll be really cool. Looking forward to that. And Ralph, I want to thank you so much. Just hang out for us 1 second. So if I can make sure I engineer this properly, and just hang on. We'll be right back. Thanks, everybody. See you next week. Oh, see, I did it again.